Okay, in the last video, we looked at trend. We said that market can either move in an uptrend, in a downtrend, or have a sideways movement. Now, here today, we would like to discuss or we'll look at what is referred to as market structure. Now, market structure is what helps you identify if a trend has been broken. For example, if market is trending up, what makes you to begin to change your mind that, okay, overall, this market has changed from an uptrend to a downtrend is what is referred to as market structure. That's the simple explanation of what market structure is. Now, for you to be able to draw market structure or know how to use market structure, first you need to understand properly what support and resistance is and how to draw your support and resistance zones. So let's start with that. By knowing support and resistance zones, then or support and resistance lines, then you can better cite what the market structure is. For example, to draw, this is the daily chart, your zones. You pick your turning point in the market. For example, this is a point to pick. We also have a point here, which market has clearly broken out of. Then we can go to the H4, which is the lower time frame, which is a time frame lower than the H1. We pick another zone. Let's say, let's pick this area. I'm using lines for clarity. You could decide to as well use a zone here. And you still achieve the same thing. You decide to use a zone here. And you still achieve the same thing. Now, these are support and resistance levels that have been drawn. Now, to identify market structure, let's zoom in. In market structure, understanding market structure helps you to understand breakouts. We'll discuss breakouts in our subsequent videos, then breakdowns, breakouts either to the upside or to the downside. Now, market structure you start your point with identifying, let's say you pick an area, you call this area the low point. When market moves up, you call this area a high point, H. As it comes down, you call this area a higher low, higher low. As it goes up, you call this area a higher high. As it comes down, you call here a higher low. Then as it goes up again, you call this area a higher high. Now, why are you calling it a higher high? It's a higher high because it's higher than this high. This is a higher low. It's higher low because it's higher than this low point. Now, this low point is here. This point is higher than this point, so you call it a higher point. So in an uptrend, you have a series of higher highs and higher lows. That is what defines an uptrend. Now, this market dropped down here. So this place is still, can still call it a higher low because it did not go below this low. All of here is an uptrend. So, okay, for example, here now, you have a higher high. So market drops, you have a higher low. So here now, Okay, let's do that again. You have a higher high here. You had a higher low here, this point. Now, as the market drops down, you have a higher low. Why? Because it actually did not go below this area. Now, you now have what is called a lower high at this point here. Why is it a lower high? It's called a lower high because it did not go above this high point. So it's called a lower high. It's a high point because market went up. But then in terms of market structure, it did not go above this high point. So it's still a it's still a lower high. Then this higher low, this market came down, and for the first time since we started here, numbering here, this we had a low point that is lower than this higher low. So we call this place a lower low. Why is it a lower low? It's a lower low because it is lower than this low point. This point was called a higher low. Now this point is called a lower low simply because it is lower than this low point. Now, as market bounces up from this low point, this lower low point, it goes up. You can now call it, okay, uh, it goes up, but still it didn't go above this area. So you call this area now a higher high. You call it a high, rather, a high. You start numbering afresh. You call it a high. Why? Because it is higher than this low point. Then market comes down a little here. You call this area a higher low. Why? This low, even though it's a low point, it's lower than this high point, but then it is higher than this low point here. So you call it a higher low. Then as it goes up to this point, you call it a higher high. Why? It is higher than this previous high point that you had here. So you have a higher high, then it comes down a little to this area of support. Then you have your low, higher low again, higher low, meaning it's a low point below this high point, but then it didn't go below this low, and now it shoots up. So we expect market to do this again, come down here. So now we'll have a higher high, and as it gets to this point, we expect a bounce. So this point will be our higher low. Now in an uptrend, in a market that is strongly trending up, this is what you expect, to be seeing a series of higher highs and higher lows, going up, higher highs and higher lows, higher highs and higher lows. Higher highs and higher lows. So as you keep having highs and higher lows, you keep breaking above resistance. This area was a resistance, broke above it. So you expect to keep breaking resistance. So in this kind of uptrend, what you're looking to buy is you're buying these higher lows. You're waiting for market to form a higher low, like here. Then you buy a higher low, then you buy. Now that's it about market structure. We could do one final example where I try to look at a downtrend. Okay, now, okay, this is a good area where you have a downtrend where market was going down. Okay, so let's start from here again. So this is our high point. So this area here, let's call it our high point. So let's say we started from there. Then this market dropped down. We'll call this area a low point. This place it dropped to. Then as it pushed up, it didn't push up above this level or up to this previous high level. So we'll call it a lower high, a lower high. meaning it's a high point, but then it is lower than this previous high point. The market goes down. It goes below this level that we had, this low level that we had here. So we'll call this place a lower low. It's a lower low because it is lower than this low. So in a downtrend, you have a series of lower highs and lower lows, meaning market is forming lower highs and lower lows. Market comes down, goes up, but doesn't exceed this point, forms a lower high, then it pushes down, forms a lower low. Now, that is what you have for downtrending markets. Then the final scenario is for the ranging market. Now, in a ranging market, okay, in a ranging market, the price is confined in an area, in a box, and is not really moving. Okay, so this area now, you can call this area, the whole of this area here, for the whole of this period, you can call it a ranging market. Now, price is just within a region, let's say this is a low point, and it's just going up and down, up and down, up and down around that area, up and down, up and down. It's not actually breaking up, then coming down. It's just moving sideways. Now, that is what you refer to as a ranging market. And when a market is ranging, it means it is not trending. And trending market is where are easier to trade than ranging market. We've come to the end of this video. See you in the next class.